Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. There's a lot of noise that financial advisors must currently contend with when managing their clients' assets and trying to create an optimized investment portfolio. But within the noise, there's opportunities. Well, I have on an industry expert to share his insights into some investment themes that he is currently watching while, trying to get through some of this noise. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to David Schassler. David is the head of multi-asset solutions and portfolio manager at VanEck. David, thank you so much for coming on the show. It's an honor to have you on. I'm really looking forward to this conversation. It's going to be a good one. Can you please tell us a little bit more about yourself and VanEck?
Yeah, let's start with VanEck. So VanEck is turning 70 years old. So we've got a 70-year anniversary. Obviously, I haven't been here for all that time, but I've been here about 14 years. It's been a
Okay.
great experience. Let me kind of break down what I think makes us different, right? So we are in New York City. That doesn't make us different as an asset manager. We've got about $120 billion under management, depending on the day, depending on the volatility. Here's what makes us different. We're and Jan Van Eck says this, I think, perfectly. We're a macro shop. What does that mean? We think about the big themes that are going to drive markets. If you kind of just take a step back,
Yeah.
look at the markets over the decades, and you'll see that themes drive performance. If you go back to the 70s, it was all about inflation, assets with scarcity, real assets perform, gold dominated. Then we got to the 80s. 80s was about globalization. Then you got into the 90s, it was about technology. Early 2000s, it was about real estate and securitization and finance, et cetera. And then we got into the early 2010s, and it was big tech. We're sitting here now, and I think the more transformative time, not only to be alive, right, to be an investor. This is, and I'm not trying to be dramatic. You've got the combination of two of the most powerful forces that I think we've ever experienced in our lifetimes, literally mashing together at the same time. So when we think about thematics and how does VanEck fit into that, I think we're right in the middle, because we're always trying to figure out what are those big themes. Because here's the thing: you miss those big themes, you leave a lot of money on the table. Right, a lot of money on the table. So we want to make sure people get exposure. And then lastly, you also asked about myself. So multi-asset solutions, that's the team I'm a part of. I work with a great, very talented group of guys. So super lucky to be part of that. And here's kind of what we do. So we offer model portfolios, and model portfolios. It's a user model. It's think about it as a user manual for our clients to best engage with our solutions. So to have a really healthy relationship with our clients, help them to allocate to our solutions. It's open architecture. So our solutions, competitor solutions, to create a really well-balanced risk managed portfolio. And I hope that that's the stuff we're going to talk about today.
You got it, David. That is fantastic. I love going back through all these different cycles, and I do a lot of research in Zephyr, looking at different, investments and how well they might perform or not perform well during those cycles, and uncovering the themes and stuff like that. And to also talk about, it's a generational time to be an investor. Yes, there's a lot of noise, and it can be hard to kind of get through all this noise on a macro level, all the macro uncertainties out there. But when you talk about just the different types of investments and the democratization of investing now, like you said, to create a diversified portfolio, it's so much easier. Now you can get alternatives. Now you can get, Bitcoin, all these different types of assets to create that diversified portfolio. Very fun time to be an investor.
Yeah, no, for sure.
We talked on the macro side. Let's start there. Let's start at the top. There's a lot going on this side, on the macro side. You got geopolitical concerns, tariffs, monetary uncertainty, fiscal uncertainty, ballooning deficit, you name it. And there's a a lot more. What do you think is the primary risk you and your team are focused on?
Yeah, so every risk bears an opportunity. So why what I'm about to say is maybe it's going to strike people as bearish, and it'll probably strike most people as bearish. I'm going to give you something at the end, which is something to buy that I think is going to go up significantly, right? So I would actually spin this and say, let's figure out how to make money given what we have, right? We can you can kind of tell yourself whatever you have to tell yourself to go to bed at night, right? At the end of the day, but you've got to deal with the realities. And if you start thinking about them strategically, you could say, hold on a second, how do I actually profit from this? How do I make money? And
Mm-hmm.
that's how we position ourselves. So when I said in the beginning that there's two major themes smashing together, one of them is the most bullish theme I could possibly think of, and that's AI. And we're going to get to that, right? But the second is complete reckless spending come from the government. It's not just a US problem, but
Yeah.
it's heavily a US problem, right? So let's break that down a little bit. So we've got out of control deficits, right? This has been covered exhaustively. The best thing about, listen, I'm a huge fan of the contributions that Elon Musk has made, but on this individual subject, he's putting a huge spotlight on the reality of this and he's bringing it to the top. I've been jumping up and down for years talking about this. He's got a megaphone that's significantly bigger than anyone that I can get on, and he's preaching to the same problems, which I love, right? Because he's bringing this to the forefront. And the reality of the situation is that we've got out of control spending. The political life is significantly shorter than that of the economic cycle. So you've got a mismatch between what personal agendas and what's best for the country. And this mismatch is kind of driving
Yeah.
a situation where regardless of which party, right, Democrats or Republicans, the only thing that they can agree on is that they should overspend. You know, what they overspend on is a different thing, but that's the thing. So we can't constantly pour it on, pour it on, pour it on. The big beautiful bill is another example of that, which is why Elon completely lost his mind, which I get, right? He bought into the concept if we're going to get tough on deficits, right? He was sold that, and then he got a U-turn at the end, which is what I expected, right? That was a divorce in the making. But
Yeah.
we've got a situation now where we're going to attempt to grow our way out of it, but it just mathematically doesn't jive. Now we've kind of got to the point where we're going to stop pretending, right? We're going to stop pretending that we're going to address this. We're not going to put forward a credible plan to curb our spending. So we're just going to step on the gas from a fiscal perspective. So if we get in a spot where you've got fiscal dominance, which is where we are now, that's a very bullish setup for asset prices. It ends in a very unfortunate way, we think,
Mm-hmm.
right? But you can make a lot of money off that because I think stocks go up in that environment, and store value assets is where you really want to have an allocation to. That gets back down to asset allocation, right? When you think about asset allocation, it's stocks, it's bonds, but it's also real assets.
Yeah.
It's also digital assets. So if you start to frame up the world in risk and opportunities, we're going to get to opportunities, but if you start to think about risks, you need to have assets with embedded scarcity. Gold is the ultimate store value asset. That's not changing. Gold's a top
Yep.
performing asset over the 1 year,
Yep.
the 2 year, the 3 year, the 4 year, probably eventually the 5 year. It's outperformed by a very, very wide margin. Not an accident, not an accident, right? Everyone's used to gold in this benign environment, right? Where gold's a sleepy asset, kind of does nothing because they haven't lived through a period like the 1970s, or at least they haven't managed money through the 1970s. Maybe you're old enough to be alive in the 1970s, but being in high school, sitting in your GTO, waiting in line for gas doesn't qualify you as an expert on the inflation 1970s. I've met one advisor, he was in his 90s, that actually managed money through the 1970s. I talk to people all the time. That was one time. So being old enough to remember the 1970s is different than managing money through the 1970s.
Yeah. Yeah, that's fantastic, David. And you bring up such great points there. And I'm a firm believer, and I wouldn't say we're in a crisis by any means, but when there's challenges and crisis, there's opportunity. It's just uncovering them, and don't just look. You said it. It kind of sounds bearish, but you got to look for the bull opportunities there and take advantage of them. And so you mentioned some, the primary risk and in the budget deficit and spending. So within that noise, where are the opportunities? You said stocks go up. It might be an opportunity for stocks overall with the spending. But what are the other primary themes? You mentioned AI. Can you kind of focus on that? And are there other themes that you guys are focusing on?
AI is such a powerful game changer. It is a general purpose technology. General purpose technologies are huge. They impact everything literally across the board, right? Civilization gets significantly better from them. You can go back in time, right? The wheel, the steam engine, electricity, the computer, the internet. These are general purpose technologies. What they have in common is they literally drive productivity across the entire system. They change the system in such a profound way. Regulations has to change to catch up to it. Everything gets meshed up. What it's going to do is it's going to drive productivity.
Yep.
The productivity eventually is going to drive economic growth. There's going to be winners. There's going to be losers in the short run. In the long run, society at large benefits in a major way. So that's the big picture. But let's kind of break that down a little bit. Let's talk about the path of innovation. So we talked about other general purpose technologies.
Yep.
You've got over 5,000 years between the wheel and electricity, right? And then you go from electricity to the computer, 150 years. Right? Then you go from the computer to the internet to AI, and everything gets shorter and shorter and shorter because technology stacks on top of each other, and the growth goes like this, and then it goes vertical. And that's where we are right now. So when we talk about why we're bullish, the world's going to change in a way that people are having a hard time understanding. Let's push that a little bit further. The people that have created AI and that are at the forefront of this are having a hard time understanding the rate of innovation that they're experiencing. They're the closest ones to it. You're going to see people living longer, healthier lives, more meaningful lives, right? Everybody's quality of life is going to continue to rise as it did with other general purpose technologies. Yeah. There's going to be more time for leisure. There's going to be more productivity. All those things are going to benefit the system, but it's not going to be without tensions. The big difference here, and people always say, well, what's going to happen to jobs? Everyone's going to lose their jobs. Here's the thing. The history of innovation is one that labor evolves with technology. It's going to be a bit bumpier this time though, right? Because why? First off, the rate of change. It's going to happen a lot faster because you've got all that technology compounding. So like the computer, the internet came out in the 90s. We didn't really realize the benefits until the 2000s, where you could sit on your phone and randomly order anything off Amazon during a meeting, find the lowest cost producer and have it delivered to your house by tomorrow, right? And it happened over kind of seemingly overnight, but you look back, you're like, well, we didn't have the infrastructure. We weren't ready for it.
Yeah.
Well, a lot of that's changing. It's going to profoundly impact everything from energy consumption. We're going to need a lot more of it. It's going to have its fingerprint on everything, but the growth is going to go vertical. And that's the point.
Mm-hmm. Yeah, that's fantastic. So David, do you have your phone? Are you ordering something at Amazon as we talk?
No, my wife's got that covered.
Yeah, exactly. Up here in Tahoe, we don't have many places to shop. We have to rely on Amazon. There's Amazon boxes at the front door all the time. You might hear the doorbell ring here soon. Um, you brought up a very good point about AI. It just how quickly it's moving. It just seemed like it was the last year when really GPT came out and went live, and now we just had a call earlier today with the AI provider, right? And it's just how quickly it's moving. It seems like it just became available to the masses a year ago, and now it's all over the place. So you got to stay abreast of, but like I say, I don't think it's going to take jobs away. It's going to help productivity, and it also brings up other investments like data centers. Um, how's your view on data centers and how, the opportunity there?
Yeah, I mean, data centers are going to be a great source of investment. They're not gonna hire a lot of people aren't going to get jobs off of that, which is kind of by the point of that, but right, it's to do things more efficiently, more productively, right? So at the end of the day, it's going to not be a great source of new jobs, but it will be a source of productivity. The thing with new technologies is that, especially this one, and I was kind of going to it a little bit before. Why is it going to be so disruptive? Not just the rate of change, but what jobs it goes after first. So jobs will be displaced. There's no doubt about that. Microsoft has laid off 15,000 people this year. How much of that's related to AI? Nobody knows exactly, right? But a large portion, right? This is attacking white collar jobs that are easily replaced, right? Coders and stuff like that. But it's gonna branch out, and it's gonna attack us in a bit of a different way than we're used to, right? When we had this in the past, it was we were gutted from a manufacturing base. This is a different thing. We're hitting the economy in a different spot, and that's going to cause disruption. And disruption is inevitable, right? If you worked at Blockbuster, you weren't thrilled that Netflix came out, and if you worked at Sears, you weren't thrilled that Amazon came out, right? But you're also still not on a breadline, right? You reacclimated into the labor force, and you most likely have a significantly better job now than you did then, right? So that's the path. It's labor working with technology to create more efficient output and to improve everything. That's the expectation. It's going to get a little bumpy, no doubt. And our industry certainly isn't immune from that.
Yeah.
You think about markets, right? Like why should the stock market close at 4 o'clock? Why? It helps for an 8 hour day, right? We can go home, we can take a rest, we come back tomorrow. Yeah. But the reality is that a world that's driven from machine-led investing, when AI has getting more of the driver's seat and making some of these decisions, if AI can solve these problems, they can be applied to the markets and it can start to go autonomous pretty quickly. And it's going to make everything better, but it's going to change things up. The need for banking, blockchain technology, moving out intermediaries. Intermediaries cause friction. It slows things down, it gums up the system, and it adds costs. We'll start to cut them out. And you could start to get a sense of how much change is going to come.
Yeah. Do you think you brought up a good point about AI and making investing automated? Do you think that makes it harder for, say, an active manager, or does it make it where markets are more efficient because data is quicker, technology, AI makes markets efficient and harder to find alpha and those inconsistencies?
I think early adopters will jump out on it and will get the edge. And then as the market catches up to it and it becomes effectively a beta where it's the expectation, everybody will play a catch up and there will be a speed game. But I think the early adopters will gain a significant edge. The question is, how long will those adopters have to enjoy the benefits of being ahead? We heavily incorporate AI. I spend a large portion of my time, and not just direct investment, but the things that take my time up, right? So if I'm going to write a commentary, I'm going to write all of the bullets to everything. I'm going to write it out in ugly form. And then I can reference back to the thousands of commentaries that I've written. So it has my exact style in there. And I can give it all the bullets that I want to. And then I can instruct it to write in the style of David Schassler. Now it will spend all of that time where I used to spend wordsmithing and spend a half a day going back and forth, making sure my tone was right. And guess what? Now it reads exactly as I would have done it before, maybe a little bit better. And now I've got half a day back. And now I'm going to spend that half a day on the investment side. I'm also going to use it on the data side. We're tracking everything. So if you're an analyst and you work at our firm, we track everything. You're going out on the road. So let's say you're a geologist and you're going down some mine and you're going to take notes of your due diligence, your research. You come back, you put it into the system, right? Now we've got all that stored. So if we're paying all this money for research and to pay for an analyst and pay for that analyst to get on a plane and fly out there and then hop on transportation, go out there, go to the bottom of this mine, you need to make that research accessible. Well, you can take all that, upload it in here, and now we've got basically a chat bot. You type into it, and I can have all that information accessible. So we're getting better, and we're getting better, and we're getting better, and we're constantly pushing the envelope. Next year, what does that look like? I have no idea. I'm excited to find out, but I have to believe performance is going to get a lot better.
Yeah. And it just, the flow of data too, is you're going to make your process more efficient. So, you can make more, timely moves, market moves, and based on data. So I'm excited for it. But like you said, in a year, you have no idea. For me, I don't have a production team. So I've used AI a lot to, you know, um, make the videos better and stuff like that. And it's a big time saver. You talked about spending. Fiscal spending is a big issue right now, and one thing that it's probably its cause is de-dollarization. What does that mean for investment portfolios moving forward?
Yeah, interesting. So I had one very strong view on that, and my view has been starting to adjust a little bit. So generally speaking, we don't believe the U.S. dollar is going to be dethroned by any other major currencies that are currently out there right now. So I'll start with that. So we don't think we're going to live in a world where the euro or anything else, the yen is going to replace us. So start with that. So we're not saying the US dollar is going anywhere, right? But we are saying that the reliance on it's going to change. How we interact with it's going to change. If you're in a situation where you're stuck as a creditor of somebody who constantly perpetually overspends, there's no way that I could run my house or you could run your house the way that the government runs theirs. You just can't do that.
Mm-hmm.
The laws of financial gravity still apply to them. It's just not going to be so obvious immediately, right? There's a lot of give that they get given the situation, but it doesn't go on forever. And this story is as old as time with the rise and fall of nations, right? This is not a new story. This is an extension of what's always been the case. It's just that it's new to the people living it right now. So start with that. But when I start to think about stablecoins,
Yeah.
the Genius Act just passed. If we're going to have, so the United States, rightfully, in my opinion, is embracing digital assets. This is a very, very important thing. It's defining the rules of the road and creating an operating framework to us to build off of. So instead of fighting and being hostile against digital assets, we're in a situation now where it's being embraced. Now, if you have stablecoins,
Yeah.
that's creating demand for dollars. And this is another source, right, of demand. This is a very good thing for the nation, given where we are right now. It will also allow us and almost in some way encourage the continuation of bad behavior. So it will allow the party to continue for an extended period of time. If if people in emerging markets and everywhere else start to look at stable coins as an alternative, you can see that driving the demand for dollars.
Fantastic. You brought up, stable coins, and we're going to talk about Bitcoin here in a little bit, but it's interesting. I was a critic of Bitcoin and crypto for years, and the more and more conversations I had with guests about it and did my own research on Zephyr, not so much about the merits of just crypto, but the impact it has on investment portfolios. I Diversification, right? It helps decrease the correlation of your other assets. And I ended up earlier this year as like, you know what? It doesn't matter what the price is. I might think we might be at the top. I missed out, but I included my portfolio because of the portfolio diversification benefits that it brought. Let's hope it keeps on breaking through to new highs. But with that being said, let's talk about diversification. In your mind, what does diversification look like? For years it was just 60/40 portfolio. Now alternatives are being available. You have crypto. What does it look like?
The 60/40 was very convenient for a long time because you were in a world of globalization. You were in a world of constantly lower interest rates. So the 60/40 is very convenient. Why would you do anything else?
Yeah.
Because if you did anything else, it cost you. And that was the world that everybody grew up in. So all the experts and everybody that knows is looking through the lens through their lifetime and their experiences. And their experiences are one of the 60/40 dominates. That's the place to be. And we're in a different environment now. And if you take a longer view, you come to a very simple realization. And that simple realization is that the world is divided into high growth, low growth, high inflation, low inflation. Just because high inflation doesn't happen all the time doesn't mean it doesn't happen. It doesn't persist for an extended period of time. The path of inflation is that inflation doesn't happen often. But when it happens, it's pretty damn hard to control and it lasts a long time.
Yeah.
So this idea that, we were early on this inflation thing. Listen, we've gotten things wrong. Don't get me wrong. But this is something we actually got really right. And right after COVID, I was jumping up and down and everywhere that would hear me and was telling people that we're going to get inflation. We're going to get a lot of it. It's going to stick for a long time. And when transitory started, we were dismissive of the entire argument, telling people this is a new regime. Here's our thoughts on it right now. We're going to be in a persistently elevated inflation regime for an extended period of time. Elevated but tolerable. Let's call it 3 to 5 in that range. So a slow, tolerable burn on elevated inflation. So above target inflation. And that's where we stay. So nothing draconian here. But in that scenario, it completely changes the calibration for your asset allocation. So our thoughts are really simple. If you want to diversify, you needed assets that perform well independent of the economic regime. Now, we've got very strong thoughts on what we believe the economic regime will be in the future. We know what it is right now.
Yep.
Um, we know that inflation's here and it's above target. We know that, right? But we think it's going to continue to be that way. But take that off the table. If I want to go to bed at night and I want to rest my head on my pillow and be very, very comfortable that I'm protected for tomorrow, I'm going to not play the guess game. I'm not going to be like, well, this is what's going to happen tomorrow. I'm going to insulate my portfolio regardless of what the market throws at me. And if that's the way that you want to think about asset allocation, that's the way you should. Because as a steward of capital, you should say, this is what I believe is going to happen. I can position that way, but I should also present my portfolio in a way that regardless of what happens, I'm still covered.
Yeah.
And now that's not stocks and bonds exclusively. That's just not.
Yep.
What that is that's stocks, that's bonds, that's real assets. And guess what? Now that's digital assets. New asset classes aren't born every day. In our lifetime, this is the first time we've seen a new asset class born, not derivations of existing asset classes, different spins on fixed income and private credit. That's just a spin on something that was already there.
Yep.
This is a completely new asset class that was born. You want to give me an asset. So let's just talk about asset allocator. I don't know anything about these assets, but I'm going to look at it from a pure quantitative lens. You give me an asset class that's purely differentiated. It's completely unrelated at its core to stocks and bonds and real assets.
Yep.
It's uncorrelated over longer periods of time. Sometimes it may look like this, sometimes it may look like that, but it's a truly differentiated asset. And it's got a phenomenal return history with it and a lot of volatility. Well, guess what? Thank you. Thank you. I'll take that. As an allocator, I'll take that because I can take that, insert it into the portfolio in a very modest allocation and potentially have a pretty sizable impact. And that's exactly what's been the case. So let's not be in this camp. I'm from the older school of investing. It doesn't get more kind of straight line box from the world that I'm from. I'm from a institutionalized asset allocation world, rigorous due diligence and all that stuff, right? That's the world I'm from. So I was not a quick adopter as well. But as investors, we don't have the luxury of holding personal biases or having the view that I'm going to not do that. And I'm going to tether myself to maybe some spiritual belief against some asset. We don't have that luxury. Our job is to look at things in a very objective lens and say, how would this benefit my portfolio? And leave everything else at the door. Leave everything else at the door. I give this little example and I'll stop my tirade. I give this little example. I give a lot of talks to advisors, and most of them are boomers. It's not a surprise when you go out and speak to advisors. They're the ones that control the wealth. And I'm a lot closer to that generation than I am the other generation. So I can kind of poke fun and tease a little bit. Now, here's the thing. I used to ask people, how do you feel about Bitcoin? Are you open to it or do you hate it? Not do you love it? Are you open to it or do you hate it? And 5 years ago, it was the cool thing to raise your hand and say, I hate it. It's rat poison. Warren Buffett told me so, all that, right? Now, when I ask the same question, right? So that was maybe 78% of the room would do that. Now it's inverted. Now people are embarrassed to start taking that position because after a certain amount of time, listen, Bitcoin's a teenager at this point. It's over 16 years old.
Yeah.
It's been institutionalized. It's here to stay. It's not going anywhere. That happened already. And guess what? If you invest in the SP 500, you already have exposure to it. So companies that are involved in digital assets are now in the SP 500. You've already got exposure. So you could pretend like you're not part of it, or you could just embrace a new technology, a new investment, a new store value asset, which kind of is a nice segue to how we think about
it. Yeah. David, that's fantastic. And that example that you use is exactly me. 5 years ago, a few years ago, I was like, no, Bitcoin, it's just not for me. I can't really understand it, can't put my arms, or if I'm going to invest in something, I want to really be able to understand it, know what I'm investing in. And it just came to the point, and I didn't really look at the price, like I said, so much of Bitcoin. And I was like, you know what? It adds a benefit to my portfolio. So why not do it? And like you said, financial advisors, they got to be able to have that conversation with their clients. If they can't have the conversation about Bitcoin with their clients, they're probably going to lose that client, especially that younger generation. Whether you like it or not, you're going to have to, embrace it, just like AI.
I was having lunch with this advisor. He's a massive advisor, and he was there and we were talking about the same exact subject. And he tells me, this is what he says to advisors when they say that. I only invest in things I understand. I don't understand that, so I'm going to leave it. And then he quickly points out that people also don't understand the mechanics of the combustion engine, but it doesn't stop them from investing in Ford and GM. It's a weak argument. It doesn't hold. The reality is it's our job to investigate, understand. This is a business of constant learning. It's a business of humility. It's a business of risk management. And that's how you're going to be successful. It's just constantly learning, have an open mind, understand you're going to get things wrong and self-correct. I mean, that's what it's all about. I wasn't an early adopter. And I would even say on the spectrum of things, why it may seem like an early adopter, in the sphere of VanEck as a firm, the firm was so far ahead. That was a decade ago. People were walking around the firm talking about digital assets and crypto, and there was a contingent of portfolio managers that were not early adopters, and I was squarely centered in the middle of that, right? Of the skeptics, and I think it's healthy to be an early skeptic.
Yeah.
But as you get more data points and as you learn more, and you go down that academic journey with it, I think you should come out on the same side that we are. That it belongs in the portfolio, and this is where I say, if your number is zero, revisit it. That zero should be a two. So what we do in our models is we've got a 2 to 5% allocation. So if you're in one of our asset allocation models, you go 2 to 5%. We think that's totally appropriate. And that used to be, if you'd have met me a few years ago, we've been talking about 1%. And why did it change from 1% to 1 to 2 to 2 to 5? Because the volatility of the asset class is coming down. It's coming down as the asset class continues to mature. It's maturing at the rate you'd expect. It's a teenager. It's starting to get more mature. As it does that, it's commanding larger real estate within your portfolio.
Yeah, David, that's fantastic. Let's stay on Bitcoin for a second. We've reached all-time highs. It's been fluctuating around those all-time highs. Is it too late to add it to portfolios, you think, if people are, hesitant? I missed the rally a couple years ago. It's too late. I'm not going to do it. What's your take there?
Here's an interesting. This is another observation I get because I have the luxury of talking to smart people all the time, right? And here's an observation. I'm going to give you another observation. Why is it that when tech funds, ETFs, or tech stocks go up, everybody buys them in at the top? Why is it that they just throw money at the top, but when assets they're not comfortable with or don't own go up, they look for a reason to sell? Why is it that every time gold goes up, I have to talk about why is it now the time to sell it? But when NVIDIA goes up, we're talking about why I should buy it. It's an embedded bias. Here's the thing. If your number is zero in your portfolio, make it one, make it two, but it can't be zero. That's our opinion. Now it sells off, take advantage of the volatility, now scale up. And don't do it in one shot. Scale it up incrementally and do it kind of over time as the volatility flares up and you get opportunities. So I'm not saying take a max position at an all-time high. Not what I'm saying at all. But what I am saying, if your number is zero, take it to two. Tactically take it to three over time, right? And that's the way that you benefit from it. You don't have the luxury of being like, well, I missed it, so I'm gonna sit this one out. Because guess what? You're gonna be singing a pretty sad tune, as you would have been since the inception of Bitcoin, waiting for it to come back to whatever fictitious numbers in your head that you think makes sense, right? And that's the reality of where it is. Same thing for gold. I think gold's going so much higher. Gold's the ultimate store of value asset. Let me say it another way. If I would have came to you 7 years ago, pre-COVID, and say, listen, this is what's going to happen. We're going to have a global pandemic. We're going to lock people in their houses. We're going to increase the money supply by over 42% basically overnight. We're going to weaponize the US dollar. There's going to be hot wars between commodity-rich countries, right? The Middle East is going to be in constant conflict. Russia, et cetera. All these things are going to happen. We're going to be in the most versatile, volatile, and peculiar political environment ever, right? We're going to be sitting. You're not even able to sit with relatives at Thanksgiving table if they disagree with you politically, and we're going to get into such a melting pot, right? And it's going to get so ugly, right? That's effectively kind of where we are if you take like the bearish view on it, but that's effectively kind of what happened. At the same time, you've got this really polarizing technology that's so wildly encouraging, and it's going to drive productivity. The bottom line is this is the perfect time for decentralized store value assets. When's the right time for gold? Now, right? It's the perfect time for that. And if you buy into that, Bitcoin is just gold 2.0. There's a completely different generation.
Yeah.
You've got all these people out there that grew up in a digital world. Guess what? The boomers are retiring off. And the people that are coming up that are going to take the baton, they view Bitcoin as gold 2.0. They grew up, you and I didn't grow up in a digital world. They did. This is natural to them to transact in this digital world, to live in this digital world. So that's what's going to happen. And it's going to become more and more institutionalized. So what we're saying is your portfolio between gold and Bitcoin, I'm at 7, maybe 7%. If you think about decentralized store value assets, I think you should have 5% gold in your portfolio. I think you should have 2 to 3% Bitcoin. And that's your hedge against all those risks that we spoke about a minute ago.
David, I think that's a perfect way to wrap it up. You just wrapped it up in a bow and tied it tight. That was fantastic. What a great conversation. I really enjoyed it. We covered a lot, brought it all together. Thank you, David, so much for coming on the show. It was an honor and privilege. Where can our audience get more information about VanEck?
Go to vaneck.com, VANECK.com. Check us out. Lots of material. Check out the model website. So we've got a whole section on our models. Sign up. So what we do is we have a commentary. It comes out every month, talks about how we're positioned, if we changed, why, what happened in the market. So that's the best way to follow us. And then you'll get plugged into the allocations that we're making.
Awesome. Thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Thank you and have a great rest of your week.